So I mentioned I quit trading. What am I doing now? I am selling options. Now, I did mention this before, and most people hear the word options and they panic. And I was the same way when I first heard options. I've heard of it a long time ago, and I was like, yeah, that's not for me. I'll stick to Forex and trading crypto and stuff like that. But then recently I saw a video and I found a strategy in options where the risk is gone. And so you have no risk, in my opinion. I mean, there's still people, who post on YouTube and on TikTok and everything, and they talk about the risk of running options. But I feel like, my opinion, if you do it correctly, there's really no risk. And then there's no maintenance. Like, you don't really have to be on the charts 24/7. You can, take a couple of days and just, set everything up and then keep an eye on it here and there, but you don't have to trade every day. Now, the income isn't as much as people say it is when it comes to trading, but like I said in my last video, people say you can make like $5,000 a day trading and all this craziness. And yes, you can, but how many people are actually doing that? Not very many. That's why there's only 3% of traders that are successful and profitable. So I found something that has low risk and is guaranteed money, and it compounds. It's a compounding thing. So you can possibly double your money every year, if you do it right, and if you're doing it with the right stocks. So how does this work? How does options work? So the way the options work is I personally use the strategy of selling options. You can also buy options, but when you buy options, that puts you in the same bracket as a trader who's trading Forex or crypto or anything like that. So when you sell options, remember, you're a seller. So once you sell something, you make money right away. And the way options works, when you sell them, the moment you sell the option, you get paid instantly. So I don't have to wait to get my profit. I get it up front, but you get it in a form of a credit. So you get it in a form of the credit, and options are done with expiration date. So you pick a price that you think the stock is going to go to. You pick an expiration date on when the stock's going to reach that price. And then you sell the option and you get paid instantly as a credit. And then as the time passes from the time you you sell it and the contract expires on that expiration date, you start slowly but surely gaining that full premium that you get. It's a premium. It's called a premium that you get up front. Now, I know that sounds a little complicated, but pretty much what it is you're getting paid to wait. So here's an example. Let's use simple numbers. So let's say I want to sell an option. And pretty much there's two strategies to this, and it's called the wheel strategy. But the wheel strategy consists of two different strategies, and they're both selling options. The first one is selling a cash accrued put, and the second one is selling a covered call. So the cash accrued put is the first step. You have two ways of getting started. You can either go buy 100 shares of a stock, or you can do a cash accrued put. And by the way, when you sell options, one contract equals 100 shares, which is another reason why a lot of people don't sell options, is because you need 100 shares of a stock. Something like Nvidia or Amazon, you need 15 to 20 grand to get started doing this. There's strategies to do it with less money, but that's more complicated. We won't get into that. So the real strategy starts with a cash accrued put, and then after you do the cash accrued put, you can do a covered call. So to break it down, pretty simple. And I'm going to make more videos on this, so make sure you subscribe, like this video, because I'm going to make some videos individually breaking this down so that it's not something where you're lost. And it makes it super easy, and I give you examples. Cash accrued put is pretty much getting paid to buy stocks. So you sell an option that says, I want to buy this stock at this price. If it doesn't hit that price, you keep the premium, because you're going to get a premium every time. So if I sell a contract saying, let's say Amazon's at $200, I say I will sell a contract to you, the buyer, that I promise you to buy Amazon at $180, which means I get a $20 discount, right? And because I'm making that promise, the buyer says, okay, well, I'm guaranteed a sale, right? So he's willing to pay a premium for that. That premium, let's say, is $200. I get paid $200 to buy the stock at a 180 by a certain date. If it doesn't get to that date, if it doesn't get to that price by the date, I keep the $200 and do it again. If it does get to that price by that date, then I buy 100 shares for $180, which is $18,000. So I need to make sure I have $18,000 in order to buy it, or I won't even be able to, sell a contract for a cash secured put. That's step one. And then there's step two is in the scenario that you was actually to buy the stocks. Now you have 100 shares of Amazon. Now you can sell a covered call. And a covered call is pretty much the opposite. Now I'm saying I'm selling a contract to you saying I promise to sell my stocks at, let's say, 220, right? So I bought it at 180. Now I want to sell it at 220. That's a $40 profit for me, right? But because I'm guaranteeing you that I would buy it at 220, the buyer would also pay me a premium for that contract. So let's say he gave me another $200. I make $200. If it doesn't hit 220, I keep the $200 and I can open up another one next month. If it hits 220, I have to sell my 100 shares at 220. I make $40 a share in profit plus the 200 that I make. Either way, you keep the premium. Whether it hits the price or it doesn't, you keep the premium. Now, the reason this strategy is so great is because if you're using a stock like Amazon or Microsoft or Google or Nvidia, these are stocks you want to have. Tesla, Meta. You want to have these stocks. You want to own these stocks. Your chances are you're buying these stocks for your retirement. So I don't care if the stock goes down or up, or it doesn't really matter because it's gonna recover. Even if you happen to, because the only risk with this is that on the cash put side, if you say, all right, I want to buy the stock at 180 and it goes down to 170, you still have to buy it at 180. Right? It doesn't matter because it's a contract. So you lose $10 on that share. However, if I'm buying Nvidia and I lose $10 on that share, within a couple of months, I'm pretty sure Nvidia is going to go back from 170 to 190 or 200 or whatever. You have time, right? This is long-term trading. And vice versa, when you sell it, let's say I sell a cash secured put where I wanted to sell it, cover call where I said I wanted to sell it at 220, then if it goes to 250, I miss out on $20, right? But for $30, I miss out from 220 to 250, right? However, I guaranteed my money, so I can't say I missed out because once I sell my shares at 220 and the stock's at 250, now I don't own the shares anymore, right? I made my money, I don't own the shares anymore. I can just come right to date, right? Now it's at 250. Now I could do a cash secured put at 220. Now, I don't want to get more in depth into this because you guys might be confused already. And I apologize if I confused you. But if I did and you're still interested, make sure you subscribe and like this video because I am going to post individual stock for each one. Individual video for each one. One for cash secured puts and one for cover calls. And then how to get started running the wheel, this is called the wheel strategy, all together so that you guys can start making some income. So hopefully you like that video. Hopefully this helped and you subscribe because you want more. See you guys in the next one.